Hello, welcome back to this week's episode of Closed by Mo. My name is Mohammed. I'm hopefully your favorite YouTube host on most things real estate. I'm also a real estate investor and a realtor based out of New York City. And this week's video is going to be a little bit of a special direction in the sense that we're going to look into the actual numbers of a deal and how to calculate the cash on cash return. Now, the cash on cash metric is not the only formula you can use to calculate a lot of different real estate investments, but it is one of the most popular ones, especially when it comes to first-time investors and house hackers. Without further ado, let's jump right into this case example of a property worth $500,000 and how we calculate the return, as well as the pros and cons of the cash on cash return analysis. Now, before I go into this completely hypothetical example, I feel like I should probably explain what cash on cash return is, right? So cash on cash return, in a nutshell, will basically tell you exactly what your return is for the amount of cash that you've invested. It's not looking at anything else. It's not looking at, let's say, future cash flow or anything like that. It's looking at year number one, the amount of cash that you've invested, how much of the amount of cash that you're getting back is the total return of that cash, the initial cash invested. So it'll basically help you answer the question, hey, how much cash income am I generating based off of the amount of cash I initially put into this deal? Now, the advantages of something like a cash on cash return is it's very quick to calculate. So it's a very quick benchmark, very quick, like a yay or no or a litmus test to figure out whether or not it's worth it to continue doing your due diligence. The disadvantages of using the cash on cash return is very simply that the cash on cash return is a very static kind of formula. It doesn't take into account the overall property, let's say appreciation in price, or the rental appreciation, for example, because something might be a negative cash on cash return in the first year, which we'll see very soon. However, if the rental income is going to keep going up, then the cash on cash return might not be the best suitable investment sort of criteria for this particular deal, because you're going to end up making a ton of money in year 2, year 3, and so on and so forth. Now, to begin with, I want to be very clear. This example is completely hypothetical. This deal does not exist. This property does not exist. I'm only using this example as a way for us to give us some calculations. Now take a look at the purchase price. $500,000 purchase price with a 25% down payment. You're at $125,000 and you have closing costs of around 2.5%. So all in, the amount of cash you've invested is $137,500. That's the amount that you're going to be paying out of your pocket. And with an interest rate of 7%, let's take a look at what the overall expenses are playing out. So when you're calculating the cash on cash return, which is the annual net cash flow divided by the amount of cash you've already invested in the property times 100, you want to look at what your top line revenue is and subtract all the different operating expenses, right? So let's say you start out with the rental potential, which is around $3,000 a month. Again, this is hypothetical. And then you subtract the principal and interest, the insurance, the taxes, utilities, landscaping if you have it, property management. I left it as 0 because I don't pay any property manager for my properties. Vacancy, repairs, and capex. These are the assumptions that are going to vary from investor to investor, from investment thesis to investment thesis. Vacancy, repairs, and capex, I automatically assume a minimum 5%. It might even vary from property to property. Of course, if you have a very turnkey property, your repairs and capex should probably be at a lower assumption. Vacancy, I take that as a 5% assumption because the property is not going to be rented all the time. Doesn't matter if it's a multifamily or a single family. That in-between time between two different tenants, you're not going to be earning any kind of revenue from that. So it's good to always keep a certain percentage of that, in a rainy day fund just to keep it to the side. So you'll see here for all those three assumable expenses, I've taken 5% of overall gross cash flow or overall gross revenue, which is 5% of $3,000 a month, or 5% of $36,000 a year. Now you'll see how we calculate the net cash flow. So you take the top number and you keep subtracting all those lines until you get to the bottom number, and you'll see that we're actually negative cash flow every single month or every single year. So if you were to calculate the net cash flow in this particular deal, so let's say you take your net cash flow, which is negative $6,600, divided by the amount of cash you've put in, which is $137,500, multiplied by 100, you'll see that you're actually almost losing 5% in the first year based on the cash on cash return. Is this a good deal? Is this a bad deal? It depends, right? One of the limitations of the cash on cash returns, like we discussed, is that it does not take into account what the future price appreciation or rental appreciation of the property might be. So you might be charging $3,000 a month on this in the first year and be at a negative cash on cash return. But in the second year, if market rates are going up steadily, you might be charging $4,000, $5,000 in year 5. These things come into play because your mortgage payment and your expenses typically don't rise as fast as you would, increase the market rent as well. So those are the kind of limitations to keep into account when you're looking at cash on cash return. Cash on cash return is preferred because it's a very quick litmus test. It'll tell you right away whether or not it's worth for you as an investor to continue doing your due diligence. Some people might say, hey, if the cash on cash return isn't at least 5%, I'm not going to waste any time doing my homework on this. Others might say, hey, if it's a negative cash on cash return the first year, but it steadily grows up, that's perfect for us because we need to 1031 some money anyway. Again, it's varies so much and it depends case by case, property by property, investor by investor, right? That's why it's not something that you should ultimately exclusively rely on, but it is definitely one of those helpful factors to keep into mind. I hope you guys really enjoyed this video. I'm going to try and make more videos that are more technical, that really dive into the numbers a little bit more to help you guys be able to calculate your own deals as well and figure out whether or not the numbers make sense for you, because what might make sense for you might not make sense for me and vice versa, right? I'll see you guys next week. Bye-bye.